So our adjusting accounts, what's the goals here? We're going to talk about how at the end of a month, and we're going to talk about the financial cycle and how at the end of a period, we might need to make adjustments to our financial statements based off of new information we learn. That's really going to be really the goal out of all of this, and what kind of accounts can be adjusted. And so this concept of periodic reporting and accrual accounting is what we're going to get to. What is accrual accounting? We're talking about GAAP accounting, generally accepted accounting principles. So remember, most people use something called cash basis. That's how we think of it. Like, hey, if I spent cash today, the average layman would think that's an expense. Now you, taking my class, should know that's not an expense, right? Just because cash went out the door doesn't mean you have an expense. We have an expense when we match it to the revenue that's earned, and we know that revenue is recognized when earned, not when we receive cash. That little nuance raises a ton of complexity in GAAP accounting. When have we earned revenue? How do we match the expense to that earned revenue? And so that results in a timing difference. Like if I paid one of you today $1,000 to do work for me that you're not going to do until next year, that would result in a prepaid expense for me and a reduction in cash and unearned revenue for you. But if I didn't account for that, I could have a timing problem in accounting. And so that's where this periodicity comes from, periodic accounting. The concept that we can break periods. Generally, businesses have cycles of 1 year. Some businesses don't, like wineries might have longer life cycles because of their products. But generally, you look at businesses within 1 year. That 1 year is split into a few different periods. We have months, we have quarters, we have half years, semi-annuals, and years. And there's different reporting for each of them. Generally, a company reports internally monthly, just like you might do a family budget monthly or personal budget. You report quarterly financial statement information. You normally send semi-annual budgeting and goals. And then annually, you report a financial year-end, a financial statement, a big one. And so normally, as the periods grow, the complexity and the level of detail needs to get better. So your yearly financial statement is normally audited and done at a very high level of scrutiny. Quarterly, it's reviewed. It's not audited, but people check the work, and and there's a little more scrutiny. Monthly, normally it's just an internal metric. So kind of understand that we break everything into periods, and how the periods line up make it important to make sure that we're doing the accounting in the right period. There's risks from accounting. Like there's a few risks that we all need to know. We can get the number wrong, the calculation risk. We can put the number in the wrong account, classification risk. We can put the wrong number in the wrong month or the wrong quarter or the wrong year, right? That's a timing risk. And so always be thinking about these different risks when you're doing your homework. So that's the big difference between accrual based and cash based, right? Revenue is recognized when we're earning it in accrual basis, but cash when the cash goes in and out the door. To reconcile the two, we make our statement of cash flows. Cash basis is non-GAAP. Why? Because you can use it to easily commit fraud. Think about it. The easy thing you can do to try to trick mortgage companies is, hey, if you want a big loan, you can have a friend give you $200,000 today, and you say, hey, I just made $200,000 for my company. Well, give me $1 million loan. If we did that, that's not GAAP because you didn't earn that revenue, right? You're just saying, hey, I got a bunch of cash from a friend. Theoretically, you might owe that cash back, right? So you didn't earn that money, and so theoretically, you can distort information. So GAAP makes sure, hey, we want to make sure that they actually earned that revenue, and that any expenses that they have are tied to that. Otherwise, you can manipulate the financial statements. So remember, cash basis is non-GAAP. Accrual basis versus cash basis. Let's go through this example. On an accrual basis, $100 of insurance for 2017. So the idea here is if you have, let's say we had a $2,400 of insurance over 24 months, and we paid it on day one. On a cash basis, we'd have $2,400 in expense in 2017, and then no expense in 2018 or 2019. But on an accrual basis, we recognize that as a $100 expense in every single month for the 2 years. So you can see how you can distort information pretty quickly this way, right? And that's why we have accrual-based accounting. When we're doing this, just so we know terms, I'm going to keep throwing terms at you, that's called an amortization of an expense. Amortization, it means that we're taking an upfront expense and smoothing it out over a period of time. Amortization. Let's see. So that's these slides. Let's see. So the concept here is revenue is recognized when we earn it. That's a fundamental. The more advanced way to think of it is when we satisfy our obligations to a customer. And we recognize expense in the periods. See, I've talked about this. I'm going to keep reiterating it because you need to memorize it. So because of this, we might have adjusting entries at the end of periods. That's the whole theme of this assignment, is at the end of a period, we might need to check how much we have left to earn. So let's use that example where a company pays me $1 million. Let's say they pay me on December 1st. They pay me $1 million for services for a year. At the end of that month, I need to decide how much have I earned. Am I earning it monthly? Am I earning it based on hours? And then I need to make an adjusting entry at the end of that month to make sure that by the end of the year, my unearned amount is correct and the amount I've made is correct. My revenue is correct. We need to do that for all of our accounts that have some kind of accrual meaning we're an asset, or deferral, a liability, related to accrued-based accounting or GAAP accounting.